Welcome to the daily video update. This is Being Prepared Monday, April 4th, where we'll look at the action in the market today and then see how things look for Tuesday, April 5th. And incidentally, I have two things just to talk about really quick. If you are on Rumble and watching these videos, be sure to subscribe. I'm not 100% sure how the whole Rumble thing works, but apparently there's more exposure to the videos once they're monetized. Well, unless you subscribe, because I have like a week's worth of videos up there that nobody's really being able to see because they're not monetized yet. There's kind of a slow time going with all of that. But my understanding is if you subscribe, you'll still be able to see those videos in your feed. So, and if I'm incorrect, please let me know, but this is my understanding of how things work. And the second thing is I did not hit my goal of making all the videos over the weekend that I wanted to. I made the monthly video, the daily video, and the daily snapshot video, and some other video, weekly video, I think is up there too. And I was just hitting the veg state after that. I just could not go on. So I apologize. I wanted to do a video about the international indexes and about the sectors and about the economy. Well, it takes a long time to put these videos together. And I just did too much. And my brain just kind of went into shutdown mode, but I'll try to get those together. I'll work on them as I can so that then when they're ready to be posted, I will certainly let you know about that. But that was a little too ambitious on my part. Okay, so let's go back and look at the day. And it was an up day, at least for the S&P. We're not seeing a lot of internal strength right now. Most of it had to do with growth stocks on Monday. There was news over the weekend that Elon Musk has come in and bought about a 9% stake in Twitter. And suddenly everybody loves tech on Monday. Now that could quickly change. That's an emotional response to what's happening. What we need to see is, will there be any follow through to this? That's kind of where we're at right now. But a lot of the tech companies did do well on the heels of that news over the weekend. But the weakness that we saw last week, Thursday especially, and then Friday, you could almost count as a down day. We just had that little blip up at the end that ended up taking the S&P positive. And we have to follow price. But some of our internal measures, and I'll go through the charts, are not showing some, in fact, they're continuing to show some weakness. So, but at the same time, don't freak out about that. Like I keep saying, we have to follow price because the market will rarely, with all the things that I look at and all the things I talk about, there's always going to be something to be concerned about. And about the time everything is flashing green at the same time, that's usually when we're at a top and we're getting ready to reverse. And the inverse is also true. A couple of weeks ago, everything was flashing red at the same time, and everybody was saying, we're going lower, we're going lower. Well, what happened? We bounced up out of that. So the markets like to climb a wall of worry. But we want to know what's going on and study this and have this in the back of our mind. And I'll show that as I go through some of the charts. But right at the open, we had a mix to slightly higher open. Now, the futures had been positive going into the open, and that might be a little surprising. Well, why did we have a little bit of a down opening? I learned a long time ago, the hard way, that don't trade the open. Don't fixate on the open. And if you think about that, look at what's happening, especially on a Monday. You've got a weekend where people were able to sit down, and companies and even the big hedge funds and have their meetings and look at things, get away for a few days. And they log into their computers, they call up all their people and they say, buy this or sell that. That might have to do more with just decisions that people make. It might have very little to do with what the stock market is going to do overall. And so that's why I look at the open and I like to watch it, but I rarely, in fact, I never initiate a new trend-based strategy at the open. I always wait as close to the close as possible. Now, I've stated this before, if you're in a position and it looks like we're going to gap in your favor. Let's say you're long and you're looking to get out, you've hit your targets, and we gap up and you want to get out at the open. Yeah, that's great. That's just adding a little bit of, frosting on the cake of a target that you've already met. And that's fine for closing a position. What I like to focus on is opening a position. And if you open a position the right way, not always, but a lot of times, the rest will all take care of itself. And so I like to let the open settle down a little bit. The first usually 60 to 90 minutes, I just kind of watch and prices blip all around. And then once the day really gets going, then I start to be more in focus of, okay, where are we taking things? And then as we get closer to the close, that's when I really start to focus. And usually when I initiate new positions, trend-based positions, it's as close to the final bell as we can get. Now, some of you may not agree with that. And then there's other strategies like covered calls and credit and debit spreads and things that you might do, where you're looking at a whole package of options, either getting in or getting out. And you just want to be filled no matter what's happening at that time. That's one thing, especially with market neutral type strategies. But a pure trend-based system or strategy, I like to have the day more defined before I really decide what to do. Sometimes you leave a little bit on the table, but I found more often than not that works to your advantage than to your disadvantage in waiting. But that's you might disagree. Okay, and you may not even be able to do it. Then the nice thing about living on the West Coast is the last hour that the market is open, that's the lunch hour. So if you work and you have from 12 to 1 o'clock free for lunch, you can come in, have your lunch. Maybe if you're allowed to get on the computer or have access to your phone or what have you, then you can make your decisions at that time. Other parts of the world, well, you don't really have that luxury, and it can kind of work throughout different time zones in the US. But anyway, all right. So after the open happened, we did see some buying come in, and that took prices up to R1. And then as the day went on, we had a little bit of choppiness, but there was some renewed buying that increased prices up to R2. And then we were able to get above R2 as the day moved on. Then we ended up closing at the high. So that's always a positive thing, and negative when we close at the low. And we ended up being up 0.81%. So it looked, pretty good. And our charts are looking a little bit better. It's our indicators that we have to kind of keep an eye on. Volume was below average, so be a little suspicious of that. You still have a lot of people that are real indecisive right now. There's not a lot of conviction as far as volume is concerned. As far as our technicals, they're still positive, but some are improving and some are still weakening. And I'll go through that. I took earnings off of here because we're kind of out of earnings season right now. And that really doesn't play in much other than if it's a headline story, Microsoft triples their profits in the last quarter, something that really shoots the market up or down. I bring up the Twitter story because that had a big influence on Monday, but that'll go away pretty soon. People are really concerned about inflation and interest rates. Of course, the geopolitical concerns. There's starting to be some real negative things coming out of the Russia-Ukraine situation as far as the people and the what's going on there as far as how they're treating the civilians, and that could be quite negative. And then my understanding also is the talks really have not led to anything. There's nothing really new to report there. So it's still very much at the forefront of things, but until we get some actionable things coming out of that, it's not really going to drive the market. People are also still talking about the inverted yield curves. Again, about a week ago, I did post a video about the yield curves that you might find useful. And then there's still the talk about releasing the oil reserves. And I discussed that in previous videos. And just what is that going to do? Is it really going to help the price at the gas pump? Is it going to take away oil that we might need in the future if something militarily has to happen? And then what's it going to be like replenishing those reserves? Because oil prices are a lot higher right now. Okay, so what are some comments that we can make about after Monday's session? The technicals are still positive, but weakening overall. We did have an up day, but internally, we're not seeing a lot of across the board strength. And it was mainly a tech day driven by the Twitter news. The Russia-Ukraine thing that I addressed, the inflation, interest rates, the China, the lockdowns are still happening there. And then, of course, the yield curves in oil that I already went through. And then the Elon Musk, the Twitter holdings that he has. Apparently, it's like a 9% stake or something. And now people are like, okay, what does that mean? I understand that it's like a silent partner type of thing now, but that's a huge portion of the company to own. Is that going to lead to anything, whether you agree or disagree? It could change things. Twitter was up big time itself. It really liked that news, and there was a lot of sympathy rallies going along with that. The economic report that came out showed that factory orders did decline overall, but that's part of the overall mix in the economy, but not a real driver in and of itself. And then I'll go through the current market valuation. They do have some updated charts, and they're still saying that the market is fairly valued. Some of you may disagree with that, especially when we start looking at yield curves, because, well, I'll just wait and address that when we get there. And then our trend is positive, but the ADX is still going down. That's kind of interesting. The bias, because we had Friday was a closing up day, Monday was an up day, so the bias remains positive, and our momentum is a little bit mixed. There was a little more damage done, especially last Thursday, than that seems to be feeding through. So I'm keeping momentum at more of a mixed level right now. We need to see Tuesday, Wednesday, we need to see some healthy advances for this to switch back to more positive. So let's go through the day session. First of all, okay, and I have things mixed up here. All right, as far as sentiment, and some of my slides are a little out of order. We're pretty much neutral. We were at 49, we were just at the left of this on Friday, where we're just at the right. So that's right midpoint right now. And then here just shows overall where we're at currently. The VIX continues to drop and is still below 20. So that shows that a lot of fear is subsiding, both on the line chart and on the bar chart. Our VIX of the VIX is still going sideways with our bars, and kind of still sideways. We're up and down, but sideways overall as far as the line chart. The ulcer index, we're well below. So it's just showing that there's not a lot of fear right now. Our different sectors, we had communication. Look at that, 2.76%. It's been really getting hurt lately. Well, it saw a good day on Monday. Discretionary, also a sector that has really been struggling. So we're seeing a lot of the weaker sectors, they enjoyed a lot of strength on Monday. And then about half of the other sectors were down, but not very much across the board. Then here's what it looks like going back to the high. Energy still in the lead. Discretionary, even with the advance, is still not doing very well. With communication, they kind of go back and forth as to which one is doing the worst. Then looking just at the tech sector, we're still above the 200-day moving average, and we were up 1.9% in that sector. So that's a pretty healthy move. As far as inflation, the CRB was up 1.5%. And we're still showing an overall uptrend. We saw not enough to show you the charts, but corn, gas, oil, the usual suspects, aluminum, they all pretty much advanced on Monday, but we're not really spiking right now. We're just advancing. And then here's the CRB against the S&P 500, where it still shows that that commodities are really outperforming the S&P, or outperforming stocks right now. And then this is just the inverse. This is the S&P is really showing weakness when compared to commodities. Now, this is the current market valuation. The yield curve, and this is what some of you may object to. They use the 10 to the 3 month. Well, that's the one that's shooting up right now. where it's not inverted. It's going in the opposite direction. And so that's where they're getting some of their fairly valued stance from. If you use a different yield curve, you might get a completely different reading from this. So that's just one thing to be aware of. The Buffett indicator comparing stocks to GDP still shows that we're overvalued. The PE ratio had been more extreme, but is coming down slightly. Interest rates, which are still historically low, even though they're rising, that is more fairly valued. Margin debt, that's an old report now. And then the mean reversion, where we had been getting far away from the mean price of the S&P, well, we're starting to come back to that, but we're still overvalued right now. Technical alerts, we saw some positive, some negative. The financial sector had a bearish MACD crossover. Banks have been having some trouble. The euro against the dollar, it's declining, and it fell below 110 as the dollar was up. The NASDAQ got above 14.3, then 14.4, then 14.5. So a lot of the strength we saw was in the NASDAQ and the NASDAQ 100. Let's see, the industrials, they have a MACD bearish crossover. Canada just still doing pretty good these days. And the health sector has been, after going positive with the BPI, has now dropped back below 80. So that's an official overbought signal. And then oil was able to get back above 100 on Monday. Looking at our intraday chart, this is where it looked like, okay, we're going to have a nice open based on the futures before the market opened. But then we saw a down candle right here. And so you're thinking, well, wait a minute, I thought the futures were up. How come stocks are going down? That's more of that backlog of a lot of orders. But once that got settled, we saw some buying coming in, and then we took off and were able to get above R1. Eventually, we got all the way up to R2, and we closed above R2 right at the high. So looking at this on a chart basis, that's pretty good. But see, we have this previous resistance, this line that's been here for a long time now. And there, even on the daily chart, it's a little bit more pronounced, where coming back, you remember this short-term resistance that we battled, and it looks like we broke through only to fall back down, where we're just a little bit below that. So are we going to see some follow through to this? Or it was this more of just a relief bounce, and are we getting set to go lower? Those are kind of the two scenarios that we're looking at right now. Then we're at off 4.46% from the all-time high. And then growth had a good day, led by the tech stocks, where value had a down day. Then comparing the two indexes, this shows that growth has been weak for most of 2022, but lately has been trying to make a comeback. Here's value versus growth, showing that it had been weak for a long time. It had been advancing and is showing some recent weakness. NASDAQ 100 against the S&P, yeah, it was up over 1% in the ratio. Here's our pure value. It actually was down 0.55%, and our growth was up 1.41%. So when you look at the two together, we're seeing, after a lot of early weakness in the year, we're seeing a bit of a bounce back overall. As far as our trend, this is what I'm talking about with the ADX. The green and the red, they're getting a little closer together. Even though they separated a little bit, the ADX is still picking this up as a weakening trend. And so we're starting to get down here closer to this 20 line, which for me personally, that's the line in the sand between trending and non-trending. Now, if you're a little more radical or a little more risky, or you like to live on the edge, you might pick up a trend right when the moving average crosses above the ADX. Okay, that's your choice in doing that. But this is still signaling that we have a weakening trend, although it is positive with the green line on top and the red on bottom. Our Arun is also showing a little bit of weakness. We're seeing a little decrease in buying power, but we're also seeing a little bit of a decrease in selling pressure, and buyers are still in control. So our oscillator continues to be positive. Decision point, no real changes there. As far as our breadth, this is where we're showing a little bit of weakness. And as I go through these charts, you'll see we're seeing new highs taper off a little bit, even though they were kind of sideways, according to based on price. We did see a bit of an advance on volume. That can be positive, but we're still below this moving average, which at least not too long ago, it served as overhead resistance. Can we break through the moving average? That would be much more positive. Now, if we're going to go back to the same kind of an environment that we saw in 2021, where you just have a small group of stocks that are pretty much leading the whole market, then we're going to see a real negative divergence between volume and price. We're still trying to sort all of that out right now, and the battle continues. Our advanced decline ratio is still above zero, advanced slightly on Monday, and so that is positive. Here's where we're seeing some weakness. We're seeing trailing off with the new highs and new lows. This moving average is rolling over, and our longer moving average is flat to slightly declining. So this had given us a lot of hope a while ago, and that really helped the market look a lot more healthy. This is starting to give us some warning signs here. But our accumulation buying against distribution selling, it had a real nice advance. But you see how volume, it was a little bit higher than Friday, but it's still well below average right now. Short term, we're well above the 20. And our moving average study coming off an extreme reading with the 20-day moving average and bounced a little bit, up a little bit with the 50, and pretty much flat on the 200. Moving average spaghetti tree, we're above all of our moving averages. And I have a 100-period moving average chart here in just a second that I'll show you, but we were able to get back above that. So that is positive. The moving averages actually look a little more positive, even with this whole mess going on behind us. But we're above pretty much all the moving averages that I plot right now. MACD, it's still positive, but flat to possibly rolling over. Then the STO, which kind of goes against whatever we think it might do, it showed a decline based on price and volume. The McClellan oscillator also declined a little bit, kind of surprising there, but we're still positive. We're above zero, but that's part of the follow-through weakness that I'm talking about. Williams percent, it was kind of flat, but coming off an extreme positive reading. I'm sorry, this is the Stoker. I could almost bring up the same chart. In fact, here it is. We're more extreme positive with the Williams percent R for that. The force index is still positive after coming off a pretty significant positive reading. Then intermediate term, here's the 50-day where we're well above that. And here's the 100-day. We were able to get back above it on Monday. Now that's good, but we have other indexes that are still fighting with their 200-day moving average. The PMO rolling over a little bit, but still positive. And then based on price, not so bad. Starting to see a little bit more of a rollover based on volume. Then our the PMO study with those that are rising is a little bit flat. We're seeing a bit of a decline with those generating buy signals and a little bit of an uptick with those that are above zero. BPI actually declined a little bit. See, that's again part of the internal weakness that I'm talking about. And here's a longer term chart. But if we do drop below 70, then that will be an official overbought signal. But we haven't done that. We're still above 70 right now. Moving average rainbow, we're trying to come back up out of the rainbow. These are some longer term moving averages that we still have to get above. I don't study those as much, but we're still seeing if price can get above that, or are we going to fall back down into the rainbow? Stochastics, shorter term, extreme positive, rolling over intermediate term, rolled over positive with the full stochastics. That could be a concern. The Sean trend meter, it was up a little bit. It's mostly based on price. So if we have an update, this is going to go up. And then the rate of change going back 20 periods, this is extreme positive. That could be a little bit of a concern. But you can see where back in November, we had an extreme reading and prices still went higher anyway. So this just gives us a current state of where things look right now in relation to where they were 20 trading days ago. So that's why I look at this, but I don't put a lot of stock in any one indicator. The summation index is advancing based on price and declining to sideways based on volume. A little bit of a concern. So our momentum oscillators, they're all positive, but a few of them are starting to give signs of rolling over. Vortex, this is looking more positive. Nice advance with the green, a decline with the red. So that's looking okay. RSI saw a bit of an uptick and we're above 50. Then our Chaikin oscillator, after giving an extreme reading, wore that off and is now turned back up slightly. The Chaikin money flow, it showed a nicer advance, which sometimes I don't understand the logic of this indicator. The ultimate oscillator looking a little bit toppy right now. As far as our different trading systems, here's the Elder. We continue to be neutral with the S&P, and here's the SPY, which is also neutral. Our SAR continues to be positive. Different charts. Heiken Ashi had a little bit of a doji-like, almost a doji-like candle, but it saw the advance on Monday and likes that so far, but this could always redraw. The Kagi chart is still positive. The Renko chart has now redrawn and is looking more positive. And our 3-line break is also looking more positive. So based on price, we're doing okay. And that's ultimately the most important thing. But it's like, okay, the car is running, but now we need to open the hood and look in the engine. And that's where we're seeing some concerns right now. Then equi-volume, we had a nice green candle for the up day. Point and figure, nothing changed, but we're still working off of that double top reversal pattern that was drawn last week. So that's still positive. Our longer term, we're still above the moving average on both charts. So that's positive for the long-term trend. And then the megas, they were up 1.93%, but they're just getting back up to the moving average now. Can they break on through to the other side? We'll have to see what happens. The special K, and I'm not going to show two charts for a while because it's starting to show some improvement here. I'm trying to, these videos are long enough. So anyway, I'm going to leave it at that. The longer term moving average study, looking at the 50-day, advanced slightly and not necessarily extreme, was flat 150 and actually declined to being flat with the 200. Looking at the broad market, see, we saw a nice little blip up here. Now, again, are we getting ready to go on higher, or is this just a little blip before we get set to go lower? But that's looking a little more positive. But if you look at the mid caps, there wasn't a big spike for Monday. Small caps, there wasn't a big spike for Monday. So we didn't see this in some of the other indexes. Then the Dow Jones Composite was actually unchanged to down 0.01%. So when you take the Dow, the trannies, which didn't have a good day, I think the trannies were kind of weak, and utilities together, we just kind of went sideways overall. The FANG stocks, they did well, up 4.15%, but we're still back to where we were before. Can we break above that? And we still have the 200-day moving average above current prices. ARC had another good day, up 4.38%, but still in a very strong downtrend overall. Then the Dow, see, it's still underneath its 200-day moving average. We have not recaptured that yet. That would be more positive if that could happen. And then here's the diamonds are still giving a neutral signal. Small caps still just kind of not really much. In fact, they were down 3.38% on Monday. And the mid caps also down 0.25% and still below the 200-day moving average. So as I go through these charts, I hope you're seeing where, yeah, we had a pretty good day, but do you see where it wasn't really followed in other areas? The NASDAQ, again, it was up 1.9%, but we're still below the 200-day moving average. We're at the 200-day moving average with the NASDAQ 100. Can we get above that, or will this act as resistance? Then the Vixen, it declined. So it shows that fear is really subsiding. We've got a long way to go to get down to 20 here. But with the advance, it's not necessarily strange to see the Vixen decline. And then here's the Qs. They were up over 2%. So that was pretty positive. NYSE, this is a positive thing to look at. The NYSE continues to be above the 200-day moving average. It was only up 0.25%, but we're maintaining a very important line in the sand. Here's the S&P 100 against the rest of the S&P. It outperformed. Then the Wilshire, we're just a little bit above the 200-day moving average. That's another positive thing to look at. Can we hold that? And then internationally, China's closed. They've got holidays going on there, but this still kind of recalculates anyway. But across the board, internationally, we're seeing markets attempting to recover, even in the face of all this crazy stuff going on. We're right up at the moving average with our all stocks, and the red line is ever so slightly starting to turn down. We need to get back above that for things to turn more positive. And then the non-US index for world stocks, it was down 0.42%. So it, again, not seeing broad-based strength on Monday. Then the dollar was up 0.35% and still in an overall uptrend. Here is the weekly chart just after one day. So this will redraw again every day. Oil got back above 100 to close at 103.28. And then gold, it was up 0.5%, but still not really doing much. So, when we get to silver, you'll see that that was actually down. Here's the ETF for gold, and there's a longer term view of the gold ETF. And then here's gold to compare it with the different yield curves. And if you want to, go ahead and pause that. But what happened to gold after we saw inverted yield curves? And typically when we see inverted yield curves, we like to see them across the board. Well, look at what's happening here. And I'll point this out again when we show the S&P chart, where some of our curves are inverted, but a couple of them are actually going up. Here's silver, which was actually down almost 0.5%, but still above the 50-period moving average. Longer term view of the ETF. Here's Bitcoin, was down, is up a little bit. It's been just chopping all around in the 40s right now. Is it going to break out and get above 50? Or is it going to break down? If we blow below 30, that's when things could get really, really ugly for Bitcoin. As far as bonds, here is the 10-to-2 yield curve. It is inverted. Here is the 10-to-5. It is also inverted. Here is the 30-to-5. It is also inverted. But then you look at the one that a lot of people use, and that's what they use at current market valuation. This is the 10-to-the-3 month. It's going up. And then the one that Edward Yardeni really likes is the 10-year to the Fed funds rate. It declined a little bit, but has not gone inverted, at least yet. Then looking at our fib retracement, we're still right around the 50% when it comes to the 30-year yield. And then this is the S&P chart against all the different yield curves. And again, you might want to stop this and just look this over and see what happened after we went inverted. A lot of times this really boded well, at least in the short term, for stocks really advancing. Now we're not there yet. And like right here, back right before the big meltdown in 2008, yeah, we went inverted, but look at the run up we had right before that. It may not look like much on this chart, but that's a pretty significant move. And then look at where we're at now, where we're not showing a uniformity with our yield curve inversions. And then they're just having a whole party up here with all these yields jumbling all together. Some are inverted, crisscross. Man, it just looks like demolition derby right now. And then internationally, some yields were up in the US, where we saw a real decline in some of the other rates. Now, this is a weekly chart, so it will redraw every day this week. Bond prices, they were up slightly on Monday, but we're still getting down to this pretty significant support level. Can we hold that area? If we do bounce, that means interest rates will go down. And then from a logical perspective, do you really see that happening? No, we see inflation really going up. So on a logical basis, but remember the market isn't, it has its own logic. We might see this break down below this level. Then the corporate bonds were down a little bit on Monday, and the current yield is 3.32%. Just to keep an eye on that. Has been rising lately, but declining over the last week or so. Junk bonds, because growth stocks were up, junk bonds were also up as well. And then this is just showing this longer term spike but we don't know if we're at a spike right now. That's the problem with this. We might say, oh yeah, it's spiking right now. I mean, if we have a little bit of a down day where this goes down, and then we just pick that as a spike, only to have it come back and come roaring back. So we have to let this indicator kind of tell us what's happening, but we're looking pretty significant right now, but we could still go higher. We were higher back in 2018, right about the time we saw the mini meltdown. Looking relative, gold against the S&P. It looks like that breakout just really has been a fake out. Here's energy to the S&P. It's actually down a little bit on Monday. And then here's growth against bonds. Growth really outperformed bond prices, which is not really hard to do right now. But tech has been having a lot of trouble too. So this can be still significant. And then here's the tech against the S&P. We're coming right up to the 200-day moving average. Can we break through? That's the question right now. And then here's tech against the 10-year yield, which as we see interest rates going up and down, that can influence the tech stocks and the tech sector. Here's the 10-year against tech, which just shows that interest rates have been going up. And then discretionary against staples. Discretionary saw a pretty nice bounce on Monday. And then here's the other thing that I just kind of noticed this, where again, we're looking at the staples, the things that you have to have. And then when that spikes, a lot of times that has marked some kind of a low in the S&P 500. Well, we're coming off of a spike right now, which really helped that advance that we saw through mid-March till the end of the month. Well, we're coming back down off of that again. So I probably won't show this chart every day unless it really starts to go up and the bottom part is starting to look more spiky. Is that even a word? And then this is just a shorter term version of that chart. But again, this can fool us sometimes. See how we spiked up here and then we spiked up again during the whole COVID plunge. It was a lower high, so that was positive. But see how we had the double spike here? Just about the time we think we get this all figured out, it throws us a curveball and really makes decision making more difficult than what it's supposed to do. And then here's the S&P against the 10-year yield, which just shows the S&P has been underperforming the rate of interest rate climbing, even though we saw a bit of a decline on Monday. And then these are the low volatile stocks. They were down because we saw growth going up. So the low volatility stocks actually declined a bit. And then between the two, it's still in an overall uptrend, even though we were down in the ratio when you compare it to the SPY. So what's our outlook for Tuesday? We still have the short-term overbought readings. Are they wearing off? Okay, we're still kind of in that window of what's happening. The technicals are weakening. You know, you see some of the charts that I went through. Follow through buying is needed to maintain the bullish stance. That's what we need to see on Tuesday, Wednesday. If we don't get that, the ADX might fall and we might go into a sideways market for a while. Just one thing to think about. If we see some real strength on Tuesday carried over into Wednesday, that could help the technical picture and really support prices going higher. We could also be seeing resistance right now, which could push prices lower. And I'll go through that again with my scenarios. We're still in a range. We're still battling between growth and value. We still have the yield curve concerns. We're still dealing with this whole oil situation. On Tuesday, we have the ISM non-manufacturing index. A couple weeks ago, we had the manufacturing index. Well, this is the non-manufacturing index. And then the trade balance, which is not a real big mover, but still part of the overall economic picture. The same geopolitical events that I've been talking about, and those don't look to really be changing anytime soon. So what are our scenarios? Are we still coming off of a short-term overbought condition with overhead resistance? Okay, that could push us down. We still are in a rising interest rate environment with a lot of yield curve concerns. That could push prices down. The internals and the broader market areas are not showing a lot of strength. Now, that could just be over the last few days. If some internal strength could really start to get into the market, that would help this down scenario from happening. But if we see further internal weakness, we might be looking at a pullback. Positive, we are having great strength after hitting, and now I'm calling it an intermediate term low since it was a few weeks ago now. The oscillators are positive, but a lot of them are showing some weakness. The moving averages, they're doing okay. They are providing support right now, but there's some other moving averages that I don't necessarily plot, and overhead price levels that we're at that could be providing resistance. Neutral. Now, this is becoming more likely at this point. Last week, this was the least likely of the three scenarios. If we continue to see our ADX dropping, this looks more like a pliable thing. We're in an intermediate term range with a lot of wild swings. As long as that keeps happening, we'll still be in some kind of a trending environment. So it's preventing a trendless condition, but the ADX is weakening, especially if we drop below 20 and we're below the moving average already. Then we might get into a situation where price movement really slows down and we get into a choppy, trendless, sideways type of market. So what's our conclusion? The S&P is still positive, but could be breaking out of that range. We're still kind of holding out for that. In the short term, we're positive, but weakening. We're lacking the broad-based strength. Intermediate term is positive. Oscillators are positive, but showing weakness. Moving averages are providing support, but there's other areas and other indexes that are providing resistance, with the Dow especially. But then you have things like the Wilshire and the NYSE, where that could be providing support. Long-term, the S&P continues to be in an uptrend because we're still above the 200-day simple moving average. Then as far as the videos, I already mentioned this. That's why I have these little asterisks here. I just didn't have the strength to get to those. But these are all the videos that I try to put out over a period of time. So if you find this video helpful, please feel free to check out some of the other videos and see if those might help you as well. So thank you very much. Have a really good Tuesday, and I'll do another update after Tuesday's session.